you interested in learning how to trade futures? In this video, we're going to talk about the financial requirements for trading futures, including how much money you need to start trading. But before we dive into details, let's just cover some key concepts. When it comes to day trading futures, it's really important that you have enough capital to cover your trading losses and meet the margin requirements. And these requirements are going to vary depending on the broker and the contracts that you're trading. So how much money do you actually need to start trading? Well, it's recommended to have a minimum capital of $5,000 to $10,000. However, this requirement could be higher depending on the broker and the contracts you're trading. So it's really always a good idea to do your research and choose a broker that aligns with whatever financial goals that you have. So let's talk about margin amounts. So when you open a position, you're essentially making a deposit to your broker. It's known as the margin. Now, different contracts are going to have different requirements set by the exchange. So gold futures, that's going to require about $8,300 per contract. The S&P 500 futures, an initial margin requirement of $12,500 per contract. But here's the really exciting part. Futures trading allows you to take larger positions with less capital. And that's the beauty of leverage. Now, leverage ratios can range from 1 to 2 to 1 to 100, meaning you may be able to start trading with as little as 2 or 3 times the value of the contract you're trading. So it's really important to understand the risks that are involved and only use an amount of money that you're comfortable with losing. Set your stop loss order, and that can also help you limit any potential losses. Now, if you're looking for a cheaper alternative, you might want to consider micro futures. So these contracts have a much lower cost of entry compared to traditional futures. So this makes them more accessible to traders who don't really have a large capital investment available. The initial margin requirement for micro E-mini S&P futures is $308 a contract. Now let's talk about potential profits and losses. When you trade futures, you got to understand the costs that are involved. This is commissions, exchange fees, margin requirements, market data fees, software, platform fees, financing costs, slippage, taxes. There's a whole bunch. Remember, there's risks involved in trading futures, so it's really important to use a stop loss to protect your capital. So we're talking about stop losses, but let's go a little bit deeper into the importance of risk management in futures trading. It's really important that you understand that risk management is the backbone of successful trading. And there's various strategies and practices that can help mitigate potential losses, protect your capital. Now, one really important aspect of risk management is your position size. And this is determining the appropriate size of the position you can take based on your account size, your risk tolerance, and the volatility of the market that you're trading. When you properly size your positions, you get to limit the impact of individual trades on your overall portfolio. So let's say you have an account size of 50,000 and you're looking at trading the E-mini S&P futures contract. So before entering the trade, you got to determine the appropriate position size based on your risk tolerance and the volatility of the market. So let's look at your risk tolerance. So let's say you're comfortable risking 2% of your account on any one trade. 2% of 50,000 is $1,000. So this means you do not want to risk more than $1,000 on this particular trade. So now we have to assess the volatility of the market. So by looking at historical price movements and indicators, you can determine that the average daily range of the E-mini is maybe 20 points, let's say. So now you calculate the appropriate position size. So you want to risk no more than $1,000 in a trade. So you divide this amount by the dollar value of each point in the contract. So let's just assume each point is worth 50 bucks. Therefore, $1,000 divided by 50 bucks gives you a position size of 20 contracts. So when you size your position to only 20 contracts or less, you limit the impact of that trade on your overall portfolio. So if that trade goes against you and you hit your stop loss, the maximum potential loss would be 20 points. Multiplied by $50, it's $1,000, the exact amount you're willing to risk. Diversification, we can use that as a key element of risk management. It involves spreading your investments across different asset classes, markets, contracts. So when you diversify, you reduce the impact of a single trade or market event against your overall performance. So this way, if one trade goes against you in grains, for example, the losses are offset by gains in another position like crude oil. Listen, futures trading can be an accessible option for individuals with different budgets. That's because we have micro futures. However, it's really important to consider the requirements from a financial standpoint, right? Choose a reliable broker, develop a really good trading plan. You want to carefully prepare and be diligent with your risk management strategies. there's doors that can be opened to financial opportunities and wealth when it comes to futures trading. Wrap this up. Let's just give you this here. This is a free trading indicator blueprint, and you get to learn about moving averages, the MACD, and normally this thing would be valued at about $197 out there, but it's totally free here. It's 50 pages, 4 videos. You can enhance your trading strategy with this thing, make better decisions. It's pretty decent. One of our better giveaways. Don't miss it. Link is to the left or down below. Hit like, subscribe. We'll talk to you soon.